For the first time in 22 odd years, global credit rating agency Moody's has downgraded India's sovereign credit rating from Baa2 to Baa3. Now, Moody's believes that India's institutions and policymakers will be challenged to take the country out of the low growth phase. The fact that there is financial stress in the system and the fact that fiscal deficit and fiscal position of the economy is worsening. This is the first time this is happening. The last time Moody's downgraded India was in 1998. When rating agencies look at sovereign credit ratings, they are primarily looking at 4 or 5 factors. The biggest of them, of course, is the GDP growth and the fiscal deficit. In both the cases, India's GDP growth is slowing and our fiscal deficit is worsening. The second factor they look at is the government's debt, especially the external debt, because that is affected by any exchange rate fluctuations. And the ability to pay that debt, which is reasonable in India's case. And the third factor it looks at is the government's policies and the effectiveness of those policies. And finally, the fourth factor is the reserves that the government has, both gold reserves as well as foreign exchange reserves, which are also reasonable, around $450 odd billion as far as India is concerned. So those are the 4 factors that it looks at before deciding on its sovereign credit rating The sovereign credit rating is really an indicator from the point of view of the rating agency of the country's ability to pay off its debt as well as interest, and whether it can default or won't default. So as far as Moody's is concerned, having rated India from Baa2 to Baa3, downgraded India in fact, it still keeps India in the investment grade. Below this is the junk grade. So this is the lowest of the investment grade, and that's where Moody's has placed India. As far as our debt is concerned, we are debt to GDP ratio, we are still in the 69 to 70% range, which is way lower than many of the other countries, including Japan, Germany and the US, where they are way above 100% of debt to GDP. And when it comes to external debt to GDP, India's is at about 20% of the GDP. So it's still pretty much in control between the external debt as well as overall debt to GDP. A key indicator of our debt payments and our ability to pay debt is in what is called the debt service ratio. Now, if you look at India's debt service ratio, it has actually been falling consistently. It used to be almost 9%, 8.8% in FY16. It is currently at 6.4% for the past 2 financial years. Financial year 19 and financial year 20, it has been at 6.4%. So despite the fact that our exports are not rising, exports have been practically flat, it indicates that we have managed to swap high cost debt with low cost debt, as a result of which our interest payments and our principal payment as a percentage of exports, which is what debt service ratio is, has actually fallen from 8.8% to about 6.4% currently. So that leads us to the key question: how does the rating downgrade impact India? It impacts a country in 2 or 3 ways. The biggest of them is it's an indicator to outside investors, especially for anybody who's waiting to invest in the country, about whether they should or shouldn't invest in the country. Now, there India is pretty well placed, because many of the Fortune 500 companies and foreign portfolio investors have pretty significant presence in India and for multiple years. So it's very unlikely that their decision is going to be dependent on a rating agency's call on downgrade. Any which way, this is still the lowest investment grade downgrade. It's not a very significant downgrade, and it has definitely not gone into junk status. So it still leaves India with a situation where these investors who are already present in the country will take a decision about investing in India independent of the rating agency's downgrade or change in status of rating. The second impact is on when the government sovereign goes out and wants to raise debt, and there again they will not be there are certain investors and certain countries who only invest in AAA rated bonds, in which case India was never in that reckoning. And so from Baa2 to Baa3 will have a very marginal impact on interest rates as far as India is concerned, and so it really doesn't have much of an impact. Our total external debt is about $543 billion, and it has risen by about $20 billion. So $20 billion at about, let's say, 4 to 5% interest rate, there'll be a marginal difference in that interest payout, and so it really doesn't have a very significant impact if we do raise another $20 odd billion in the current fiscal. And finally, it impacts companies from India who are going to raise funds from abroad in what is called external commercial borrowings, and they will have to face this ratings downgrade where they will be asked to pay higher rates of interest. But truly, if you look at it, global markets are flush with funds right now, and the very fact that this is a borrower's market currently, Indian companies will be in a position to extract better bargains, because they should be able to extract, in fact, better interest rates rather than paying higher interest rates because the global markets are so flushed with funds. And so I think that is not going to have a great impact on these companies either. India raised about $50 billion of external commercial borrowings last year, and when these companies go out and raise these funds, they are in a borrower's market, and they should be able to bargain better rates for their companies, because they are the ones who have options available in a market that is truly flush with funds. So all in all, if you look at it, there is hardly any impact of this Moody's downgrade on either India as a nation or most of the companies as a whole.